Hey everyone, this is the second part of our series of the 10 most common investing mistakes. In the first part, we did talk about the first 5 mistakes, only looking at the share price, only looking at the dividend yield, buying hype stocks, selling after the first drop or profit, and going all in on one stock or investment type. If you want to know how to avoid those mistakes and why so many people are not aware that those are investing mistakes, I recommend you to watch the first part before you watch this. I will link it up here and in the description below. Anyway, for the one who watched the first part, welcome to High School Dropout Advice again. If you need subtitles, click on the subtitle button right here. Through Patreon, you can get into our Discord community where you can get directly in touch with me and other subscribers. Mistake number 6. Listening to forecasts. Many might think you need to inform yourself about a stock, which is correct, and I totally agree. The problem is that people rely on the forecast to be right. I'm sure that you have listened to countless forecasts which turned out to be wrong. The problem is forecasts, especially stock price forecasts, should not be taken seriously. It has the strength to provide the stock some momentum in direction, but the main focus should be on the company's core fundamentals. Let me give you an example. I know a young investor who invests in meme and hype stocks. He tells me that a short squeeze will happen next week. So I asked him how he knows that it will be next week. And he replied, "This is because everyone is saying so." This is, in my view, a big mistake. If you don't understand the market mechanic, how a short squeeze happens, and those fundamentals are not given, short squeezes will not occur. It does not matter how many people tell you something. If the fundamentals are not provided, it will not happen. It does not change that you don't understand the stock market and that you did not do your homework. I would prefer that every investor have their own opinion on a stock and have their own forecast rather than listen to someone else. I also want you to pay attention that a forecast further in the future tends to be more accurate than short-term ones. It's easier to predict a price target 2 years from today than next month. It's because stocks are volatile but tend to move up when the fundamentals of the company are given. So please do your homework and give your investment your own forecast based on your research and knowledge and not on someone's hype. Understand that YouTubers generate money with views. If they hype a stock or investment, they get more views than if they tell you it's just an okay investment. I said in February that Workhorse is a bad investment, but people don't like to get criticized for their investment, so no one watched the video. They want that YouTuber hype their investment so they feel that they are right. So please don't fall into this trap. Don't get trapped in an echo chamber where you only listen to what you want to hear about your investment. So the next mistake is only looking at the PE ratio. This is a little more advanced. People who understand the price to earning ratio understand that the company is priced according to the earning. So if the earning of the company is $5 and you are willing to pay 30, then the PE ratio is 6 because you pay 6 times the price for the earning. So focusing on the PE is not entirely wrong, but it will become wrong if you solely rely on this metric. You need to understand that there are different industries with different kind of multiplicators. For example, mortgage companies like Mr. Cooper got a PE ratio of just 3.03, which is super low when comparing it with Apple. Apple's PE ratio is 31.41. So is Mr. Cooper a cheap buy? You need to understand that Apple is mainly a big software and tech company and not just a hardware company. A software company, tech companies, fintech companies have other PE ratios others than manufacturers, mining, mortgage related, real estate investment trusts, cruises and other business models. So each PE ratio will be different from industry to industry. The time cycle of a company plays also a very important role. Is it at the beginning of the company or at the end? Like for smaller startups without earnings, they have a very high PE ratio because they are not profitable yet and they are without any earnings. But they have a very high PE ratio because they have the potential to disrupt a proven industry. So looking just at a PE ratio will tell you very little about the company itself. Number 8. Trying to time the market is a very common investor mistake as well. But it's so common and so many investors are focused on to time the market so they can brag in front of other investors about how well they understood the stock market. I always said that timing the market is not controllable, but controlling time in the market it is. So why do you care to buy perfectly at the bottom at $22 when the stock is at 110 in 4 or 5 years? Who will care if you bought in for 22 or 25? It's a common mistake because most people are short-term focused and ignore the long-term perspective in investing. I'm sure that all of us made some trades and at first it looks like we have perfectly bought or sold at the bottom or top and we felt like geniuses. But a couple of days later we had a lower bottom or a higher top and we feel like idiots. So don't let short-term results taking you away from your long-term aim. I always told my subscribers and viewers, your investment is like a healthy toddler. You know that one day it will be able to stand up and walk and run. We don't know the exact date, but as long as the toddler is healthy, we know the day will come. The same applies to your investment. So don't try to time the days of failure or succeed. Have the patience to wait until they finally succeed. Mistake number 9. Trading is not necessarily a mistake, but I know that 95% of traders are unprofitable and cannot even beat the SP 500. This is just the fact that it's difficult to outsmart the market. But I know that some profitable traders make more than investors in the first couple of years. The problem I have with trading is that it's not the purpose of investing. Investing for me means generating wealth, passive income, and using that to be financially free, which means I can do whatever, whenever, and whichever, and with whoever I want. If you are trading, you just became your own employee, which is not the purpose of investing. It's also no secret that traders will hit their personal ceiling rather quickly. Investors have way more room to grow because it does not take them a big effort other than time. So it's no surprise that investors will make more in the long run because their earning and investment will grow in an exponential way and traders are growing in a linear way. You see a lot of billionaire investors and you see only little to non-billionaire traders. You see a ton of multimillionaire investors and of course less multimillionaire traders. The problem the society perceives these two individuals is very different. A Wall Street trader making 300k a year with its luxury sports car and suit look better than, let's say, Family Jones, who had invested in Apple the last 25 years. The United States has more multimillionaires than we think. New studies showed that 8.1% of the US populations are millionaires. So every day when you go out and meet 100 people, you can be sure that you have met 8 millionaires. The problem is that most millionaires don't look like the millionaires you have in mind. Being a millionaire does not mean you need to look and spend money like Hollywood stars, pro athletes, and drive luxury cars and live in a big mansion and all those things like that. So in short, don't trade, because trading is taking the focus away and the purpose from investing. Now let us talk about the last point, number 10. It's to have no or bad money management. You cannot invest well when you don't know how to manage your money. This is pretty simple. If you use your money which you need to pay the rent at the end of the month, then don't use it to invest in stocks or cryptocurrency just because your friend told you it will go up tomorrow. The simple rule is, if you cannot afford to lose that money, don't invest it. Many people are ignoring this and invest money which they need to withdraw later. The same applies to withdrawing your profits. There are so many people who get impatient and cash out their couple thousands of profit when the original plan was to invest it in for 20 years and use it for retirement. I'm not saying anything when it's an emergency like health issues, but I see so many ignore their original plan and buy a luxury sports car, take a nice vacation, or do something else that is unnecessary and not helping the investment to grow. So please be disciplined, write down your aims with your investment and follow. Only invest the money you can afford to lose, and very importantly, don't let money change you. Just because you have 1 million in your account does not mean you can live a fundamental different life. The money should just be there to get you closer to financial freedom, where you can have the option not to work to make a living, but to live the way you want. Money is the currency to get you more time and freedom. It does not make you better or worse. So never think that if you have a lot of money that you are superior or vice versa. And don't think that you can start a fundamental different life with 1 million. Even billionaires get broke. And with 8.1% of millionaires of the US population, being a millionaire is nothing special anymore. Actually, I know many single-digit millionaires who still feel very poor and would never describe themselves as wealthy. It only takes one unfortunate event like an accident and a large medical bill to destroy what you have. So be humble, stay disciplined, and stay invested. Anyways, for legal reasons, let me tell you that I'm not a financial advisor, CPA, politician, or realtor, so always consult with an expert before making a decision. Everything said here is purely my opinion and is for entertainment value only. Remember to do your own due diligence, and if you like my video, then please subscribe to my channel. Thank you so much and see you hopefully in the next video. Thank you, bye!